Good morning, everyone. As we all realize, we in yet another day of a lockdown. Unfortunately, we are likely to remain in lockdown for the foreseeable future, be it at scaled down levels over time. So we thought it's quite appropriate that we start talking about some of the themes that are emerging in the investment markets and that we believe will drive investment decision making going forward. For those of you that have not participated in a webcast via Zoom before, you will note that on the left-hand side at the top you have a black bar, and that black bar right in the middle there is a Q&A button. So if during the presentation you have questions, please jot them down under the Q&A, and we will provide you with written answers to all the questions that we have received post this presentation. The theme of today's webinar is to talk about passive investing versus active investing. And I think some of the things that I will say might surprise you. But I do love the quote that Jack Bogle, the original founder of passive investing or inventor of passive investing used, and that is, don't look for the needle in the haystack, just buy the haystack. So where are we right now? I think it's very important to recognize that things from an investment perspective will not be the same post-COVID-19. I think we all are beginning to realize that there isn't going to be a V-shaped recovery. This crisis has literally hit the fundamentals of economy, and those fundamentals are consumer behavior and consumer spending. So even once we're in an unlocked situation, I don't think everyone is going to be rushing to behave in the same way, to spend money in the same way. Virtually everything around us for a foreseeable future will be very different. I think all of you will agree that right now everyone is poorer and is feeling poorer, which means that, again, recovery will be slow. The downgrades that we have seen in terms of South African sovereign debt has meant that the currency has depreciated very, very significantly. And that again talks to affordability of buying imported goods, to traveling overseas, to excess expenditure. From a regulatory perspective, I think there will be a focus on increased taxation, not only in South Africa, but also governments worldwide need to fund the fiscal and monetary stimulus that is being thrown at the global equity market, global economic markets right now. And that increased expenditure can only come from increased taxation. Who are you going to tax? You're going to tax the wealthy. And I have already seen some of the plans for South Africa, but there are plans worldwide to start looking at this concept of wealth redistribution. There is also this concept that wealth taxes can be applied in situations like these because people don't have an exit strategy. Given that many countries will keep their borders closed, particularly close to immigrants, particularly in light of the growing unemployment within their own economies, it means that your ability to go somewhere else where tax rates are lower will just not be there. Visas will not be issued. And consequently, you kind of become trapped. And hence you can be taxed at higher rates. Regulation 28, I think that there is an increasing risk that Regulation 28 might be amended in order to raise money to fund the stimulus efforts. As much as President Ramaphosa announced the 500 billion stimulus package, it does include 370 billion rands worth of loans, which we are still to negotiate with IMF, World Bank, BRICS Bank, and African Development Bank. So, it's not money that is already on the table. It's still money that we have to get. If they don't get that money at sufficiently favorable rates, they will have to turn to retirement funds. We have already seen Land Bank in trouble, in potential default. There are steps being taken behind the scenes, I believe, to rescue the situation, but we will see more corporate defaults to come. And that really talks to the volatility. The volatility is here to stay. Because there isn't going to be a quick recovery from this crisis like there was post the global financial crisis, because we are going to have a lot of stop-start type of volatility, truly the only antidote to that is diversification. And then we've seen some very strange things happening in the financial markets, and you all would have observed the oil futures dropping to below, I think, minus $37 a barrel, where suddenly, for the first time in a very, very long time, financial instruments, which originally originated as contracts where you could trade physical commodities, over time became instruments for market speculation. And all of a sudden, given what is happening with the glut of the oil supply and not sufficient storage facilities worldwide, those contracts were turned back into potential contracts where delivery would need to be taken of the underlying commodity. And suddenly, anyone who was holding a futures contract was desperate to sell on the same day. And was because the alternative was that the last guy standing would actually have to take physical delivery of barrels of oil and store them somewhere. I think we all as South Africa need to prepare for the waves of bad news to come. We have not escaped this epidemic, not at all. We have merely managed to flatten the curve because of the infections coming into the country from mostly upper middle class overseas, visitors or residents, but coming back from overseas. The infections and then the secondary infections really being infections of their friends and family and some healthcare workers. This virus has not hit the townships yet, and it will. So we are projected to hit the peak, infection rate peak in September. And we do need to prepare for periods of grief and bereavement. And I think that most of us will not be untouched by what is about to hit South Africa. And then, of course, corporate news will be awful. Earnings are down. We will see more debt defaults. Land Bank is just a precursor of what's to come. Bankruptcies, we need to see if anyone is willing to continue to fund the debt of our SOEs. A lot of SOE debt is about to mature. It requires rolling over, so it requires willing investors to provide ongoing funding to SOEs. Let's see if we find them. So in an environment like that, you have fear. And fear-driven investing requires a new paradigm and a new way of thinking about your investment strategy. Now, this slide is not a slide that I prepared now. It's a slide that I presented at the Singularity University presentation in September last year. And I obviously cannot for a second pretend that I had any knowledge of what was to come. But even then, we believed that the world of investing was changing. And obviously what has happened now is just going to accelerate that change. So our kind of 4-pillar investment paradigm hinges on the following: low management fees demanded by investors. Those low management fees can only be delivered by managing money differently, and that's really where passive investments come in. Given that active investing does not add value, and I'll demonstrate that just now, we do believe that alternative investment strategies, so that's investment strategies which are completely uncorrelated to the market, will come into their own, and those are strategies such as private equity funds, infrastructure funds, real estate, commercial real estate, venture capital funds, unlisted opportunities will become something that investors will focus on in terms of trying to find alpha or outperformance. And then platform style, virtual service delivery. And obviously we are living through it right now in the form of this presentation. But, going back to September last year, even then we saw the trends towards technology driving innovation and driving the virtualization of service delivery. So why passive management? A number of reasons, and I'll go through them in more detail just now. One is obviously low management fees, top performance, a very wide range and themes and investment options available to you as investors. Efficient and immediate implementation, much more efficient than if you're just investing with an active asset manager. And top investors worldwide are opting for passive solutions, and they're doing it for a reason. So more than 50% of assets, retail and institutional, in the United States is now managed on a passive basis. So let's start with fees. You know, we've got this core belief that low fees are here to stay. But more importantly, low fees are the only aspect of investment that you can control. You can't control the markets. You cannot guess which manager will become, you know, the top performer next year, but you can control what you pay for the experience. In terms of fees, we have seen regulators wade in and enforce disclosure and transparency on the financial services industry. And for the first time, we are talking about concepts such as total investment costs, transaction costs, you know, things that up until then were hidden from investors. Most investors purely focused on management fees. Of course, that increased level of transparency of seeing how many layers of fees there actually are in this equation is validating the lack of trust of investors of the financial services industry. The same investors have increased access to information, and they've got social media to ask and pose questions too. So, you know, there is this very active ecosystem of people trying to find out more information. And the growing awareness, expectation of clients means that, you know, this concept of being able to charge extravagant fees is really going to disappear. Of course, then you have the cost reduction methods such as technology evolution, which again will drive clients' expectations towards low-cost solutions. Given what has happened in the financial markets, I think the concept of final investment outcomes will again become key. Given that people are now looking at real losses in their savings accounts, there will be an increased focus of members of retirement funds, of individual investors, on how do we get back to where we were. And then from that point, before the crisis started, and then from that point, how do we get back to the concept of being able to save the type of pot of money that we need at the age of 65 to retire comfortably, because this pot has been depleted. And then, of course, never a crisis goes to waste. Whenever there is a crisis, there are new entrants and new products entering the market. And finally, you know, the variety of passive funds, which by far exceeds what's available on the active side, means that there is absolutely no reason why passive investing is not going to become the norm. When talking about fees, you know, I love going back to, and those of you that have listened to my presentations before, you know, it's my very favorite quote, and it comes from National Treasury and a paper that they commissioned in 2013 on charges in South African retirement funds. And it won't surprise anyone to know that we are among the highest cost countries in the world. But there's a quote in that paper which basically says that a regular saver who can reduce the charges on his retirement account, so that's his retirement fund or retirement annuity, from 2.5% of assets each year to 0.5% of assets annually, completely doable. By the way, the 0.5%, you know, we have retirement annuities and underlying portfolios, which we price at 0.4% per annum, so it's not an unachievable goal, would receive a benefit 60 times greater at retirement after 40 years. So imagine 60% of that pot that you are saving for the age of 65 when you can retire, 60% of what you could have disappears in fees over the years. If you invested a lump sum and not, you know, regularly saved amounts, then that pot would in fact be 80 times greater in size. So fees matter. I thought, I'll make it a little bit more real for you. And I know it's a busy slide, but, all I've done, and I'm not picking on any one manager, I've just picked some managers who are, firm favorites among trustees or firm favorites among retail investors. And I've looked at exactly the same product offered by each one of those managers. I threw in a hedge fund just for comparative reasons. But I've looked at exactly the same product offered by Coronation, by Alexander Forbes, by Allan Gray, by 91 Stroke Investec, and by ourselves in the Sygnia Balance 70 Fund. I've looked at unit trusts because unit trusts are very heavily regulated, and all performances that you see in the unit trust industry are net of all fees. So there is much less scope for fiddling of institutional surveys. And incidentally, I'm not making that statement lightly. We are increasingly seeing numbers in institutional performance surveys being manipulated. But in the unit trust space, where you have trustees overseeing the running of unit trusts, and because obviously unit trusts touch the retail investor, there is a lot more regulatory scrutiny over what you are seeing. The fees are a lot more meaningful. So, Coronation Balanced Fund, all things being equal, after you've taken into account management fees and transaction costs you on a one-year basis, let's just focus on 1 year, 1.77% per annum, almost 1.8% per annum. Alexander Forbes, 1.4% per annum. Allan Gray, 1.1% per annum, and that's only because their performance has been so poor, they've had to give up some of the performance fees. Over 3-year period, that fee is in fact 1.5% per annum. 91, 2.7%. Sygnia Skeleton Balanced Fund, management fees and all costs included, 0.54%. And then a hedge fund, 7%. And that's not an unusual number. This is just one of many hedge funds, and average hedge fund fees range from around 5 to 7%, if not higher in some instances. But let's make this a little bit real for you. So let's assume that the same 6 managers have undertaken to deliver a 10% return to you as an investor. So we are all aiming for the same finish line, a 10% net of fees return. The fact that the fees vary so significantly means that, if I was to look at it as a sprint, Sygnia Skeleton Balanced Fund, without doing anything, just by virtue of charging a low fee, has such a head start ahead of its competitors. We only need to deliver 10.54% per return for you to walk away with a 10% return. Someone like Allan Gray has to deliver 11.1%. Someone like Coronation, 11.8%, before they can give you 10% and charge their fee. So you can see that the passively managed funds or low-cost charging funds have a head start on the ultimate performance, which is very, very significant. So I'm very pleased with the fact that when we look at the comparisons of multi-asset class unit trusts across the spectrum, our total expense ratios for our skeleton balance funds are, if not the lowest, then second lowest across the entire market. So in the quarter to the end of December, the Sygnia Skeleton Balance 70 Fund had a TER of 0.42%. In the high equity category, medium equity category, we were second with a TER of 0.47. And I just want you to look at some of those funds right at the bottom. The highest TER in this category is 2.7%. So it's a massive difference. And then in the low conservative category, which really should be priced at a very low fee, simply because the bulk of your instruments in the strategy are fixed income instruments and cash. So you are paying for cash. Sygnia Skeleton Balanced Fund, 44 TER of 44%. The highest TER is 2.49%. But let's move off the topic of fees. That is not the only reason why passive investing matters. Let's look at performance, because ultimately that's what investors want. It doesn't matter how much you charge for the proposition. You know, if I put on the table clothing from Pep stores and clothing from Gucci, you might still opt for Gucci simply because of the perception of top quality. So is there something inferior about passive investing? You know, my belief is, first of all, before I move on to the actual performance, is that, you know, this concept of index tracking versus active management is really one of how much do you want to pay for gaining market exposure? And it doesn't necessarily have to be an exclusive proposition. You could incorporate both strategies into your overall investment strategy. But why is incorporating index tracking sensible? Well, it's sensible for a number of reasons, which are facts. You know, I'm not going to depend on some subjective statements. I'm going to illustrate every single statement I'm making with facts and data. Very few active asset managers outperform market indices on a consistent basis. So sure, in any given year, Coronation might outperform, next year Allan Gray might outperform, but they don't do so consistently. So you cannot select that one manager that will always beat the market. And then, of course, once you've deducted their fees, then even fewer managers outperform the market. And then you've got the behavior of investors. So most of us have been taught to diversify our risk. And that means don't put all your eggs in one basket, appoint a number of managers, make sure that you select asset managers with contrarian styles so they perform differently in different market cycles. So let's unpack this a little bit. So you've appointed Allan Gray and Coronation. They will perform differently in different market conditions. So what you are betting on is that when Allan Gray outperforms because the market suits their value-based investment style, Coronation will underperform, you are okay, you're in the middle. Next year, the market cycle changes, Allan Gray drops to the bottom, Coronation goes to the top, you're okay, you stay in the middle. So for the privilege of always staying in the middle, you pay active asset management fees. Frankly, why bother? Why not just buy an index tracking fund? But of course, there's also no evidence that index tracking funds delivers average returns or in any way inferior returns. And again, I will show you that in a second. And the next issue is next decade is likely to bring single-digit returns to these markets, certainly in real terms, after inflation. And hence, there will be fewer and fewer opportunities for active asset managers to outperform. And hence, diversification is key. But let's look at numbers. So the first statement I want to make is that passive management has won the performance debate. And again, not a subjective statement. Passive management has won the performance debate worldwide, including South Africa. And there is a very good survey, so you are more than welcome to go onto the website, confirm numbers. It's produced by SAP Survey. They've just recently changed the link to that survey. And the link is on the slide, and we will circulate a copy of the slides to all of you. And what the survey does is it looks at different geographies. It looks at the general equity unit trust category or in each country, and it compares and looks at the number of actively managed general equity unit trusts that have underperformed the that geography's market-specific benchmark. So United States, the most commonly used benchmark is S&P 500, and so the SAP survey looks at the number of actively managed general equity unit trusts which have underperformed S&P 500. And it does so rolling over 5 years, over 3 years, and over 1 year. So what do the numbers show? United States, 78% of actively managed unit trusts over 5 years have underperformed the S&P 500. In South Africa, the number stands at 90%. In countries like Australia, 80% have underperformed. Canada, 88%. Europe, 77%. The numbers are fairly consistent. So, if I invited you to a casino where the odds were 80% probability of losing, would you play? But this is my favorite slide, and I call it my asset manager fruit salad. And what we have done is we've looked at, so these are performances gross of any fees, but nonetheless, we've looked at the Alexander Forbes Global Large Manager Watch survey. So that's an institutional survey of global balanced regulation 28 compliant portfolios of the largest managers in South Africa. So these are their shop window portfolios. This is how they truly demonstrate the value that they add. And what we've done is we've basically looked at those managers in calendar years and ranked their performance from the top to bottom performer. So you've got managers in 2007, their performance 2008, 2009 through to 2019. And we have given a different color to every manager. And so I've chosen Allan Gray for no particular reason because the pattern is exactly the same for everybody else. But let's look at Allan Gray. 2007 in the middle, 2008 at the top, 2009 and 10 at the bottom, 2011 at the bottom again, and at the top in 2013, and at the bottom in 2014, and so this carries on. So if you think you can select asset managers, who right now is willing to bet me on and predict who the top performing 3 managers will be in 2020? But let's look at the active managers' arguments. So one of the arguments we have seen over the past decade since the global financial crisis, where the popularity of passive funds worldwide has increased and money have shifted in literally tsunami sizes away from active asset management into passive products. One of the arguments that active asset managers have used is that passive investing is fine in a bull market, but the true value add of active asset management will be shown when we hit a bear market. That's when they will come into their own. So again, I revert back to unit trust performances, and I revert to the biggest bear market that we will ever live through in our lifetimes, and that is now. And so multi-asset class, high equity category. So that's global balanced regulation 28 compliant portfolios, just in the unit trusts. So the performance numbers are shown net of all fees. And I've looked at the first 3 months of this year to the end of March. And there are 230 unit trusts in this category. Sygnia Skeleton Balanced Fund, a passive fund, is 35th out of 230 funds. Some of the bottom performing funds actually over those 3 months lost over 25% in value. Over 1 year, let's extend it a little bit, Sygnia Skeleton Balanced 70 Fund is 23rd out of 222 funds. So where is this amazing active stock selection skill coming through? What is interesting, by the way, and it does talk to global diversification, Investec on 91 has obviously done very well over this crisis time, and we did investigate why they have done so unusually well. And as it turns out, they have an office in Hong Kong. And obviously Hong Kong was affected by the coronavirus much earlier. They knew what was happening in China, and they knew what the effect on financial markets would be way ahead of anybody else, which is why 91 could position their portfolios, with that benefit of knowledge, and good for them. But as you can see, Sygnia Skeleton Balanced Fund 1 year outperforms all of its big competitors, Coronation, Allan Gray, Prudential, it's all below there. But I then looked at what does Allan Gray and Coronation say about passive management. They are obviously not taking this debate lying down. And I've looked at some of the articles that have been published by Orbis, Allan Gray, and by Coronation, and these are some of their quotes. So Allan Gray says, the fact that active management cannot add value on average does not prove that some skilled managers can't do so over time. So here is an admittance that active asset management cannot add value on average. If you pick an active manager, it is important to have confidence in the manager you choose, especially as managers who are likely to outperform the index over the long term are also likely to underperform for periods of time. So again, how much appetite do you have for the roller coaster ride of some outperformance, some underperformance? And then this one is my favorite quote, and that one says, the difference is that passive strategies consider the views of every human being investing in a market. The group of people managing the Orbis funds is rather smaller, and they select and weight companies by rigorously assessing the relationship between their prices and fundamentals. Which group of people you would rather have managing your portfolio is up to you. Well, up to me, I'm going with the herd instinct. And then Coronation. Carl Leinberger, Chief Investment Officer. This quote is actually very, very important, and I'll explain why. Asset allocation is generally accepted to be the most important investment decision. The gains or losses from selecting the right or wrong equity manager will typically be dwarfed by the gains or losses stemming from the right or wrong asset allocation decision. Asset allocation is the big call, and you need to get it right. And I could not agree more. So if you look at a product such as a Sygnia skeleton fund, our asset allocation is managed actively. The underlyings in terms of equity exposure, bond exposure, international exposure, all passive, low cost passive. And we price the product at 0.35% per annum and lower for the institutional market. So, you know, on balance, you could say you are buying asset allocation, and asset allocation costs about 0.35% per annum. If you look at a product managed by Coronation, and I reference you back to this 1.8% or 1.77% per annum fee, that would imply that you are paying around 1.2% for their stock selection skills. So if asset allocation costs 0.35, then the balance of the fee that you're paying must be for the extraordinary stock selection skills. So we will look at some of the extraordinary stock selection skills just now. But let's go into some more quotes. In my opinion, true active managers have nothing to fear. Passive investing leverages of active investing because active managers make markets more efficient. The two strategies are complementary. The next quote I don't like because I fall into this category which effectively defines me as a Muppet investor. And I find it quite offensive. Passive strategies genuinely make sense for some investors. Examples include investors who have not done the due diligence themselves or have not taken the advice needed to select skilled active managers. So obviously Muppet investors. Okay, I'm putting up my hand. I'm right up there. Those who do not have the long time horizon needed to prosper in financial markets. Big supporter of passive since early 1990s, and I cannot talk about myself as not having prospered in financial markets. And then 2013, head of institutional investing at Coronation, Kirshni Taram, had quotes in an article she wrote, even for developed markets, while passive investing may have been very viable in the past, the jury is still out as to the relevance of this type of investing will have going forward. Well, this was 2013. By 2020, more than 50% of assets, as I said, in the US is managed on a passive basis. More than 30% is managed on a passive basis in the UK and growing. And hence, I think her predictions were wrong. Then another quote. Firstly, we believe that costs should never be considered in isolation. The compounding of returns over the long term can result in material gains. And hence, investors should always look at investment returns less costs. We'll get back to long-term performance by Coronation net of fees just now. And then we are unequivocally active managers and believe in the value that we add to client portfolios over the long term. When investing with an active manager, understand their philosophy and process, and when assessing performance, don't just look at a snapshot in time, but at the full long-term picture. So let's do so now. Exactly the same category, global balanced, Regulation 28 compliant unit trusts, Sygnia Skeleton Balanced Fund performance over 3 years to the end of March, 12th under 107 out of 179 unit trusts in this category. Coronation, 52nd, Allan Gray, 66th. On a 5-year basis, so no short-term snapshots, we're now looking at longer-term periods. Sygnia Skeleton Balanced 70 Fund, 19th out of 122 funds. Coronation Balanced, 49th. But again, I have been asked, about the fact that Sygnia Skeleton Balanced funds are not truly passive because we do manage the active asset allocation ourselves, and obviously evidence proves that we do it quite well. I've just included a couple of slides, by the way, on before I get to asset class specific funds. I've included a couple of slides on conservative products and passive global balance passive strategies, but in the conservative space. And in the conservative space, Sygnia Skeleton Balanced 40 Fund, again, over 1 year, 3 years, 5 years, is right up there in the first quartile. Over 3 years, 10th out of 140 unit trusts in this category. Over 5 years, 11th out of 98 unit trusts. And here is Allan Gray, which has often marketed themselves, and in particular, the conservative products as being the capital protection products in South Africa, and they're best known for that. And here is Allan Gray Optimal Fund, Allan Gray Stable Fund, well below Sygnia Skeleton Fund in a bear market, and then 3 years, 5 years, again, right at the bottom, and over 5 years, the Allan Gray Stable barely beats the Sygnia Skeleton Balanced Fund, but Optimal Fund is once again below Sygnia's fund. So just a little bit of a brag fund. This is performance of our skeleton products, high risk, medium risk, and low risk since inception. So it's longer time period than 5 years. And Balanced 70 Fund is 11th out of 86 unit trusts that were in this category over the longer term time period. More funds have been launched subsequently. Sygnia Skeleton Balanced 60 Fund is 6th out of 54, and Balanced 40 Fund is 7th out of 75 unit trusts. But let's look at other asset classes. So let's forget about global balanced portfolios and let's look at asset class specific performance. So the first one is, let's look at South African general equity unit trusts, equity performance. And here, you can track, using index trackers, you can track many different indices. But if you look at Sygnia Top 40 Index Tracker, it's 18th out of 215 funds. The SWIX 40 Index Tracker is 30th out of 215 unit trusts over 1 year. Over longer time periods, 26th out of 172 funds, 35th out of 128 funds. And again, comfortably beating many of its competitors. What is interesting about tracking an equity index in South Africa is, something else that you might want to consider, given the requirements of Regulation 28, and obviously the fact that the JSE is not the most interesting space to invest in right now. And that is the composition of those indices. So if you look at our Top 40 index and the SWIX Top 40 index, and the restrictions that Regulation 28 places on offshore investments of 30%, you can actually rig the system a little bit by investing in an equity index tracking fund, because many of the top holdings in those indices are actually international companies with absolutely no exposure to South Africa. So as much as you are investing in the JSE Top 40 Index, at least 50% of that index has actually nothing to do with South Africa. It's composed of shares, the ones in orange, such as Naspers, Prosus, Anglo American, BET, which actually have no operations in South Africa. So you're kind of gaining offshore exposure, while from a regulatory perspective, you are investing in domestic equities. But then international side. And really, in terms of the international investments, I really do not see the point of employing active asset managers. And I think it's extremely naive to believe that domestic managers in South Africa have the skills, the expertise, the depth of experience to manage global strategies sitting at the tip of Africa. Possibly the only one that I would rate in the space is 91, simply because they truly do have global operations. So if you look at some of the index tracking funds that Sygnia has launched, again, much more cheaply, and their performance in the international space, a FANG Plus fund, which is the technology-focused fund over 1 year to March, is second out of 81 unit trusts. More importantly, the S&P 500 fund, where the management fee is 10 basis points, not 0.1% per annum, not 1% per annum, not 0.1% per annum. A 17th out of 81 unit trusts in the international category, way ahead of Allan Gray's and Coronation's. Over 3 years, again, let's focus on S&P 500, 15th out of 55 unit trusts. If you look at 5 years, S&P 500, 13th out of 55 unit trusts. Need I say more? And do you honestly want to invest with active managers and pay the outrageous fees that you would be paying? So if you just compare, the S&P 500, I did on Twitter make a bet that S&P 500 will continue to outperform Allan Gray Orbis over 5 years. They have not taken me up on that bet. And perhaps this is why not. Over the last 5 years, S&P 500 has delivered almost 13% return versus 6% return delivered by Allan Gray Orbis funds. But now let's move on to some of the interesting things about index tracking funds and passive world. You have such a wide range of themes and options available to you. This is just a menu of different types of funds that you can invest in via Sygnia. There are obviously a lot more thematics available offshore and even listed on the JSE in the form of exchange traded funds. So you can gain offshore regional exposure by investing in MSCI World Index or into Europe or into Japan, US, UK, S&P 500. We have domestic specialist funds, so you can choose between your all-share index, that's the full index, or the top 40 version of it, the full SWIX index, or the top 40 version of it, the capped SWIX index, the Divi index, property, bonds. So effectively, you can access every single asset class via index trackers. In the offshore specialist space, we have a global property index fund, we have emerging markets index fund, MSCI World Index Fund, and then some interesting thematic funds which have performed incredibly well. So Sygnia Fourth Industrial Revolution Fund and FANG Fund, both of them technology oriented, have done incredibly well. Then you can access global balanced portfolios, that's our skeleton funds. And then something interesting, which has nothing to do with Sygnia, but it is available on our platform. But I find it an interesting instrument given the times we live in. And that is the APSA New Wave notes listed on the JSE. You have to be a bank. An exchange traded note is very similar to an ETF, and I'll talk about ETFs and what they are just now. But it's exactly the same. It's very similar, but it needs to be issued by a bank. So what you can do is you can convert your rands into dollars by buying the exchange traded note. So instead of trying to externalize your money, incurring a whole lot of expenses, if you don't want to hold rands, you would rather hold dollars or pounds or euros, you can do so by investing in the New Wave ETN. So that's my preferred way of increasing my offshore exposure when I don't want to be exposed to the market, but I don't want to be exposed to the rand. I want dollars, not rands, in my portfolio. In terms of index tracking, look, I'm a big fan. I managed my very first passive fund as a 24-year-old working for Southern Life Investments in 1993. And I've been a believer ever since. In terms of Sygnia, right since the inception and even going back to the years of African Harvest, we have managed index tracking funds. And we were in fact the first asset manager in South Africa to launch a fully replicated equity index tracking funds. So not index tracking funds which hold 20 shares. It's index tracking funds holding all the shares. In 2003, we were the first index tracking manager, passive manager to launch a bond index tracking fund. 2008, the first ones to list listed property index tracking fund. In 2012, we were the first manager to launch global balanced passive funds, skeleton funds. 2015, the first ones to launch international passive funds in South Africa, and then technology-focused funds. We are the largest provider of index tracking exchange-traded funds listed on the JSE, and the largest provider of international index tracking ETFs as well, with a 13-year performance track record. So we are believers. Now, what are the advantages of index tracking and passive investing over traditional unit trust investing, should you wish to go this route? And that goes to the core of how do you invest in passive strategies, because you do have a choice. If you're a retail or institutional investor, you don't really have a choice. You either invest in a unit trust or you invest in a segregated portfolio managed by an asset manager. But on the retail side, effectively, in a unit trust, depending on the time at which you submit your application to invest, your money and your application will be processed, and your money will be invested at the close of the day. So, given the volatility in the markets, when you are actually transferring the money from your bank account to, say, Sygnia's bank account for investment in unit trusts, and you do so at 10 o'clock in the morning, your money will only be invested literally the following day at the unit price struck at 3 o'clock, and at market value of that unit trust struck at 3 o'clock in the afternoon. Much can happen, as we have seen, between 10 o'clock and 3 o'clock in these markets. So this is where the advantages of exchange-traded funds come in. You can literally buy an exchange-traded fund through a stockbroker immediately. So you don't have to wait for 3 o'clock pricing. You buy what you see on the screen at that point in time. And you can, because exchange-traded funds trade constantly, whereas unit trusts trade once a day. Now, what is an exchange-traded fund? There's no magic to an exchange-traded fund. An exchange-traded fund is a unit trust. It's just a unit trust which has been taken. It is subject to exactly the same regulations and monitoring and trustees and custody, and it's a unit trust. It's just that in addition to being a unit trust, it's a unit trust that has been listed on the Johannesburg Stock Exchange like a share. So it's a tradable unit trust, a constantly tradable unit trust, as opposed to a once a day tradable traditional unit trust. So as I said, you can invest in exchange traded funds via a platform, list platform, or via a stockbroker account. There are never any liquidity issues with exchange traded funds, so you can always exit instantly. The exchanges require that every provider of exchange traded funds, such as Sygnia, also appoints what's called a market maker, a bit of a technical term, but it's a large financial organization which specializes in providing liquidity. So they become the buyer and the seller of last resort. So if there are no bids on the stock exchange, no one else wants to buy your ETF, they are obliged to buy that ETF. And in Sygnia's case, we've appointed the world's largest market maker called Jane Street. Disadvantages of exchange-traded funds over traditional unit trusts. You do have to pay stockbroking charges, and the prices might not 100% reflect the market value of the underlying assets, although when they don't, they get arbitraged away very quickly, because the price of an ETF is subject to supply and demand on the stock exchange. So there are buyers and there are sellers constantly bidding for those exchange-traded funds. But if there is any arbitrage opportunity, that arbitrage opportunity these days gets exploited very quickly. Now, there's one other point I want to make about exchange-traded funds in South Africa, which isn't the case internationally. And there are some risks with exchange-traded funds internationally, which are not present in the domestic markets. So in terms of our regulation, our exchange-traded funds are unit trusts, and they have to hold the underlying assets. We are not allowed to hold derivative instruments to give you a simulated exposure to the market. If we are managing a top 40 ETF, it needs to hold the top 40 shares. Internationally, ETFs, instead of holding physical shares, are permitted to hold purely derivative instruments. And one of the reasons that you have seen this craziness with the oil price had to do with various arbitrage activities in the oil ETF space, and the inability of the oil ETFs to respond because they were the holders of those futures contracts. So that disadvantage doesn't exist in South Africa, and you are protected. Now, in terms of index tracking funds, is an index tracking fund the same? There are index tracking funds, index tracking funds, and index tracking funds. But what you should be comparing is you should look at relative performance of an index tracking fund. Easy to do in the unit trust space. Exchange traded funds are more complicated, because in the exchange traded funds, it's a unit trust, but the distribution of dividends between different providers varies in terms of timelines. So sometimes you will look at an ETF and it is, it has just distributed all its dividends to investors, and another ETF tracking the same index has not made a distribution yet. And it optically appears as if one ETF has outperformed the other, where indeed it hasn't. So just something to be aware of. Unit trusts are fine. You can compare like for like. Tracking error. So that is the difference between the performance of the actual portfolio and the market index. I mean, obviously and ideally, there should be no difference between the market index you have chosen and the product tracking it. But usually things such as charges, fees, how efficient and how good you are at managing that index tracking fund will determine what that tracking error is. And then method of management. If you invest in an index tracking fund which replicates the index, so if it's a top 40 index, we hold all top 40 shares, the chances are we will match the performance of the index very, very closely. If you are an index tracking fund which employs something called optimization, so you don't want to bother with buying all 40 shares, so you only buy 30 shares, then obviously that gap between the performance of the index and the performance of the product you have invested in might be much wider. And then I'm coming to almost the end of this presentation, but what are other top investors doing? Well, I've looked at the selection of headlines from Financial Times in the past 6 months. And I have to be perfectly honest, I could not find a single headline which talked to money moving out of passive into active asset management. Quite the opposite. If you look at some of these headlines, and there are many, many more. UK active fund managers suffer bloodbath in 2019. Goldman Sachs enters the European ETF battle. So one of the biggest shocks in the financial services industry is seeing this movement towards passive and is joining the race. Index funds break through the $10 trillion in asset mark amid active exodus. US active funds suffer record $143 billion exodus in December. BlackRock attracts $104 billion in new clients' money in second quarter. Why would the UK government switch to passive investing? And so it carries on. So as you can see, this is the herd. And then to quote Warren Buffett, my, and I guess everyone's favorite investor, the first quote comes from his Berkshire Hathaway letter in 2016, and it talks to the way in which he has instructed the trustees of his trust to manage his assets after his death. And he says, I believe the trust's long-term results from this policy, and that policy being a 90% investment in an S&P 500 index tracking fund and 10% in cash, will be superior to those attained by most investors, whether pension funds, institutions, or individuals who employ high-fee managers. Another one, a low-cost fund is the most sensible equity investment for the great majority of investors. My mentor, Ben Graham, took this position many years ago, and everything I have seen since convinces me of its truth. When trillions of dollars are managed by Wall Streeters charging high fees, it will usually be the managers who reap outsized profits, not the clients. Both large and small investors should stick with low-cost index funds. And finally, huge institutional investors viewed as a group have long underperformed the sophisticated index fund investor who simply sits tight for decades. A major reason has been fees. Many institutions pay substantial sums to high-fee managers, and that is a fool's game. And so, to the final slide. You know, I often start this presentation with saying, why passive investing? And then, talk about the top net of fees performance with better investment outcomes, the fact that you've got, standardized or customized investment strategies, that it's a perfect cost strategy, and you can still select your active asset managers, that it's the most sensible choice for international investing. But frankly, having listened to me for almost an hour now, is the right question not why passive investing, but rather why active investing? Why is it that in South Africa, passive managers are on the back foot trying to defend themselves? Because frankly, given all I've shown you, you should right now be asking yourselves, why are active asset managers not standing up and defending themselves? And on that note, I would like to thank you for participating in this webinar. There are some questions, and I will take and answer some of them. But please send us more questions if you have the questions, and we will answer those questions in writing. So one of the questions is, do you think the next debate would be smart indices versus tactical blending of market caps versus market caps? I think that smart indices, tactical asset allocation strategies, overlaying index tracking funds, those are the trends of the future. So it's index tracking is evolving. It started off 20 years ago as just tracking an index like S&P 500. Now the products, as I've hopefully illustrated, are becoming more sophisticated, and the strategies are becoming more sophisticated. Now, I do believe in thematic indices, such as, Fourth Industrial Revolution, because they give you exposure to interesting market sectors. What I'm not a fan of is something called smart beta strategies, where it's really a wolf in sheep's clothing. So smart beta strategies are trying to portray themselves as passive strategies, but the actual index or the decision making or the stock picking is based on some quantitative model. And usually it's a black box model. So you don't actually know how those decisions are made. And I actually think smart beta strategies are more closely aligned to active strategies than they are to passive strategies. So do we, that is Sygnia tilting towards tactical blending, whereas other managers are using smart blending. We do believe that, being at the tip of Africa in an emerging market asset allocation, tactical asset allocation. So making the right decisions between equities, bonds, and offshore exposure at the right times is the key decision in a balanced portfolio. And hence, that by far overshadows which asset manager you have appointed. And that asset allocation strategy in our context, and in the context of the fact that for the past decade and going forward, we have seen central banks running economies rather than anybody else. So economies have not been left to the forces of supply and demand post-global financial crisis. Central banks have actively intervened and skewed those forces. And consequently, in that kind of environment, we believe that tactical asset allocation, so making investment decisions based on macroeconomic factors, is the true value add, rather than using quantitative approaches. Another question, I agree that all evidence indicates passive is a better choice on both an absolute and risk-adjusted basis. However, if all market participants agree and everybody starts investing passively, markets will become completely inefficient. Yes, theoretically. And that is an argument also used by active asset managers. However, what I hope I have illustrated is that there is now even if every active manager has been eliminated, there is such a wide range of index tracking funds out there today that, if the issue of passive versus active was one of everybody invested in S&P 500 or everyone invested in the SWIX index, then yes, of course, the markets would become completely inefficient. But given that you have, multiple different indices that you can track, where people are actually creating thematic indices, they're creating their own bespoke indices. Passive management becomes just another way of managing money on a low-cost basis. And also, to be perfectly honest, I don't see the disappearance of active asset managers anytime in future. They are here to stay. There is lots of money to be made out of active asset management. And as long as there's money on the table, particularly look at the hedge fund world, 7% per annum fees, people will play and people will take chances, and there will always be gullible investors who will invest with those managers. On that note, I know there are a lot more questions, but I think I've run out of time. We will answer all your questions in writing from this point onwards. But what I wanted to say on my behalf and on behalf of Sygnia, thank you very much for participating in this webinar. I think this is the new way forward in terms of how we are going to engage with investors, particularly given that the lockdown is really not going to disappear anytime soon. This is the virtualization of the client servicing experience. But most importantly, to all of you, please stay safe. Please keep your families safe. I think we're in for tough times ahead. I think we're in for sad times ahead. And we need to be there for each other. We need to be there for each other as a community. We need to support those in need. We need to support businesses in need. And each and every one of us needs to be there in one form or another. So again, thank you very much. Stay safe, keep safe.